Here are the 4 reasons why the bond market confirmed the Fed is running out of time to crash the economy. Why the second wave of inflation has already started. We all know that from the Fed minutes, they have said from their staff's projection. At the time of the March meeting, including a mild recession starting this year. Federal Reserve has never predicted a recession before the recession. Like really, why start now? If you've never done it before, why start? It's sort of like when we do something and haven't done it before, then why start now? Especially if it's not beneficial. Are we facing something worse than a recession? Maybe a depression? Just think about if the government tells you something bad. It could be worse, or it could be the opposite. Are you really going to believe everything they tell you? Have they always told the truth? Probably not. I would suggest not. Maybe inflation can't be contained back to 2% after all. BlackRock believes inflation isn't falling below 4% anytime soon due to lost productivity. Why, you ask? I will explain later. So far, core CPI is 5.6%, still above the Fed's funds rate. The Fed has 2 options right now, to cut rates or to keep hiking rates. The bond market seems to believe both are a little too late. Why the bond market confirmed the Fed is out of time to crash the economy. Why the second wave of inflation has already started. I will explain it all right after this.
How you like that? How you like that? Nah. Look at you, now look at me. Look at you.
Welcome back, everyone, to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here. And you know what to do, and push my button, the like button, if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you are a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get into the bookstore. You want it to be real. You want it to be true. You want to be my client, don't you? And my client's collaboration book, it's already yours. Adversity equals success. It truly is already yours. So once you get your head out of the gutter and back into reality, then it is already yours, and you can have anything that you want in life. If you want to become my client, join my Patreon today. Oh, and for my naughty boys, this is my client Teddy Eazzy's book, Wicked Pussy Perfume. It is a femdom novel, and it's about money, the stock market, and stockings. Such an amazing author and such an incredible book. Order your copy today. All of my naughty boys, order your copy today. If you watch my last video about Warren Buffett, told you to buy this instead of TLT. Congratulations. You just got much wiser. Or did you? However, I didn't make it crystal clear what instrument he refers to buy. So here it is. I am sure you probably already guessed it. Yes, he is saying to buy 1 to 3 months T-bill instead of TLT. After this video, you will understand why that could be a wise option for you. Obviously, I can't give you any advice. It's your money, your responsibility. Your money, your responsibility. Understand? Okay. 1970s inflation had 3 separate waves. Now we are on the first wave down. The Fed has 2 options. Option A, the Fed will soon start cutting rates and start an episode of hyperinflation, effectively ending the United States of America as we all know it. Because once hyperinflation gets going, there is no turning back. No country has ever defeated hyperinflation before utter and complete destruction took place. Option B keeps the rate high and keeps hiking rates slowly. Tell the market recession is coming. Ask corporations to stop hiring and to start firing. Crash the stock market. Let the incompetent businesses wipe out. I think option A is for the people that own gold, silver, and Bitcoin. That's when you can see $1 million or even $10 million per Bitcoin. I don't think the government or the Fed wants that, because once US goes down, who is in charge? They will lose control. They want their power and control of the people. So option A is not now. It could happen at some day, but it's not in 2023. That leaves door number 2 open, which is to keep hiking rates and keep it higher for longer, as they said before. They want to crash the economy and the stock market. They want that perfect 2% inflation again, thus maintaining their credibility and their control over us. However, the stock market has been fighting back. Even the bond market's having doubt about if they can actually succeed. BlackRock thinks a big reason why inflation can't get to 3% anytime soon is because of falling productivity due to remote working does not work. Working from home usually doesn't work. People don't like to work. Most people are programmed to take orders from the manager, take orders from the supervisor, take orders from the boss. So this is what I believe. It takes a special type of person to work for themselves with a lot of strength, mental toughness, showing up when they don't want to, showing up when the sun is shining. Yes, if you have mental toughness and you can take responsibility for your day and plan ahead hours and hours beforehand to make your few hours count, then become an entrepreneur today. If not, go and apply for the regular job with the regular boss and the regular hours and the regular routine, the regular traffic jams and the regular lunch breaks and coffee breaks. Supreme Court allows $6 billion in student loan debt canceled. What? A settlement that will allow thousands of student loan debts to be canceled will go into effect after the Supreme Court on Thursday declined to block it. The Supreme Court, in a brief order, rejected a request made by colleges challenging the settlement. The Justice Department says about 3,800 of the affected loans involve the 3 colleges, and approximately 400 of them have already been discharged. The government has already started implementing the settlement. This is $6 billion of stimulus printed yet again already. The Fed can't cut rates without unleashing a massive second wave of inflation with trillions of excess liquidity still in the system. Inflation is here to stay until the labor market sees some real weakness. If you think $6 billion is nothing, I don't think it's nothing. I would love $6 billion. It's not nothing. It's a lot of money. A lot of this. A lot of vacations. A lot of freedom. $6 billion. Yes. Gimme. I want it. So fiscal stimulus as the first reason. The stock market's performance in the first quarter came as a surprise to many investors. It shocked me, with the Nasdaq posting a bull market-sized rebound. It is just a melt-up, a move in stocks lacking a strong economic underpinning. Traders like what they see in the market history, with the S&P 500 posting huge years after first quarter starts that are this strong. A Federal Reserve judged to be near the end of its rate hiking cycle has helped change the narrative on stocks too. Stocks failed to extend a 4-day winning streak on Tuesday after new labor market data raised fears that the economy may be slowing too much for comfort. Under the hood, the recent big gains for the broader market index mostly came from a few big tech stocks, which dominate the market weight approach of the S&P 500 index. Stocks rallying give people confidence to spend as the second reason. Bets that the Fed may cut rates by the end of the year, meanwhile, have brought out both glass half full and half empty debate. Soft landing that lets the central bank ease up, or more serious, recession that forces the Fed to abruptly reverse course. Chief financial officers at large corporations are still in the half-empty camp, according to a new quarterly survey of CFO council members. Still being the operative word, as little changed in the CFO outlook quarter over quarter in spite of the market's rebound, and hints from the Fed that its pressure may soon abate. CFOs, by the nature of their position, tend to be focused on risks and less likely to go out on the limb with their predictions as a result of it. The quarterly CFO Council survey is a sampling of the views of the chief financial officers at corporations across the economy. With this quarter's survey including responses from 30 CFOs gathered between March 17th and March 28th. Last quarter, more than half of CFOs said it was more likely than the Dow Jones Industrial Average fell back below 30,000 before reaching a new high. Even fewer CFOs this quarter rate the chances of a new high in the Dow under 15%, as being more likely than a fallback below 30,000, 57% of CFOs. There was elevated uncertainty within the C-suite group versus the prior quarterly survey, with nearly 1/3 saying they don't have conviction about the next trend in stocks. The latest data from the jobs market released in Tuesday's JOLTS report showed a steep decline in job openings for the first time in nearly 2 years. That could be bullish for stocks if it gives the Fed the evidence it has been looking for in terms of a cooling in the labor market and more reason to let up on rates. Or in a worst case scenario, could represent the beginning of a more serious downturn for the economy that the Fed now can't stop. What? Notably, for the soft landing camp, there was no increase in layoffs even as job openings tumbled. But the latest survey was completely just before the surprise OPEC Plus decision on Sunday to curtail crude oil production, which introduces a new factor into the battle against inflation. This increased oil and gas prices and boosted Michigan inflation expectations to 4.6%. Oil price spiked is the third reason. Regardless, inflation is not going to get back to anywhere near the Fed's target of 2% anytime soon. Do you hear that, the Fed? According to the survey, more than half of CFOs predict that inflation will not return to 2% until 2025. What? Now, a few remain unconvinced that even pegging 2025 as a return to more typical inflation is a safe bet. You already know why the Federal Reserve's rate hikes have backfired from my last video. and at this point are boosting the price of housing prices and the rent prices, thus exacerbating the inflation. Shelter inflation is the fourth reason. That's why Warren Buffett keeps on buying more T-bills every Monday. Go Warren, go Warren, go Warren. Yay! I love Warren. You are such a good boy for watching my video right till the end. Bye.